This is the Coronation Podcast.
Welcome to Investing Insights by Coronation Conversations, the podcast series where we explore the world of investing and personal finance. I'm your host, Chinere Peters. I head the customer experience function here at Coronation Asset Management. Now for today. Today we'll be talking about portfolio construction. This is the process of building a diversified investment portfolio that aligns with your financial goals and risk tolerance. Now, don't worry, we'll be explaining in a lot of detail what this means. Because with so many investment options available, it can be difficult knowing the kind of portfolio to create that works for you. That's why we're here. And we are excited to share our expertise on how to build a diversified investment portfolio using mutual funds. Now, mutual funds in themselves, they offer a convenient way to gain exposure to a broad range of assets, sectors, and geographical regions. They are definitely an ideal choice for many investors. But then the question is, with thousands of mutual funds to choose from, how then do you select the right ones for your portfolio? Now in this episode, we'll be breaking down the basics of portfolio construction. We will discuss the benefits of using mutual funds, and we'll provide you with practical tips on how to build a diversified portfolio that meets your investment objectives. Now, whether you're a seasoned investor or you're just starting out, this episode is designed to provide you with valuable insights and expertise to enhance your investment strategy. Joining me today is Somkene Jipreze. He's the Asset Liability and Portfolio Manager in Coronation Asset Management, a seasoned portfolio manager. Somkene, welcome to the show.
Good afternoon. Looking forward to having this discussion about mutual funds and portfolio construction.
All right then. So let's just go down to it. What exactly is portfolio construction?
Portfolio construction is the process of creating a diversified investment portfolio that aligns with whatever your financial goals and risk tolerance are. So it involves selecting from a plethora of assets such as bonds, stocks, alternative investments, so that you can achieve the best and optimal balance between your potential risk that you're exposed to and the potential return that you can gain from your investments.
Quite interesting. So it helps us achieve an optimal balance, right? But then why is it so important? Why should our listeners actually construct their portfolio?
Because any investor wants to manage their risk, no matter how risk averse or risk friendly they are. So they want to manage risk, they want to increase their potential returns, and they want to achieve their long-term financial goals. So when you diversify your portfolio, you can reduce your risk by spreading your exposure from only one particular asset or market to many different ones. So you make your investments more resilient to market fluctuations. You avoid the chance of all your portfolio plummeting at one go. Rather, even if part of your portfolio doesn't do so well, the rest of it is in other things that are doing okay. So you are reducing the effect or any negative effect that you expose yourself to. And well-constructed portfolio can help you stay focused on your long-term goals rather than get caught up on, the short-term market volatility.
Very interesting. So if I hear you correctly, portfolio construction really helps you to make your investments very effective, and it helps you find that right balance between risk and your potential return.
Precisely. So it's about building a portfolio for yourself that aligns with what you want to achieve, what your financial situation is, what investment goals that you're trying to hit, and whatever your risk tolerance may be. So by doing this, you increase your chances of hitting those objectives. And those objectives can be anything from saving for retirement, saving for down payments on a house. Maybe you want to get a new car, saving up for your children's school fees, anything that involves money that you want to look forward to. Those are all legitimate financial goals, and building your portfolio properly can help you achieve them.
Very interesting. So I believe that our listeners now have a great introduction to what portfolio construction is all about. Let's go down to mutual funds then. Now, we know that from what we described from the beginning, mutual funds are quite a popular choice for building a diversified portfolio. Can you just explain a bit more how they work, Somkene?
Okay, so mutual funds are a fairly simple product, even though they may sound complicated. Essentially, imagine we have a bucket, right? And all the investors put their money into this one bucket, whether they are bringing 500,000 naira or hundreds of millions of naira. They all put their money into this one bucket, and we, as their portfolio managers, invest the entirety of the bucket, thereby sharing the benefits from the mutual fund in an equitable manner across all the investors. They also provide some professional management. So experienced fund managers make informed investment decisions, help individual investors save time and effort, and they offer economies of scale.
Okay, so I believe that you also mentioned what these benefits already are. So let's just to summarize, you've talked about economies of scale, you've talked about diversification, you've talked also about professional management. So these experienced fund managers help make informed investment decisions, make saving time. That makes a lot of sense. Okay, so let's then go into what type of mutual funds are available.
Okay, so there are a whole load of different types of mutual funds, and that makes sense because there are also a whole load of investment objectives for different people, right? So they are usually named after whatever the majority asset class or main asset class of the mutual fund is. So the most ubiquitous one that we all know is the money market fund. Money market funds invest in short-term instruments that are no longer than 1 year. They're very liquid, they're easy to enter and easy to come out of. Then we have fixed income funds, which focus on bonds, long-term investment, whether they are federal government bonds or corporate bonds or even state bonds. Then you have equity funds, which focus on the stock markets. You have balance funds, which take a little bit of everything, bit of money market, bit of fixed income, bit of equity. You can have dollar funds, which focus on dollar-denominated investments, and there are a whole bunch more. You can have halal funds, which are specifically marketed to investors of Islamic faith, so that they can invest while also feeling comfortable that their investments are in line with their religious beliefs. So there are mutual funds of all kinds that appeal to all types of investors. Yeah.
Very interesting. So now we've spoken around portfolio construction, we've spoken about mutual funds. Let's then dig deeper. How do our listeners build a diversified portfolio using these mutual funds?
Okay, so investors can use a combination of different mutual funds to spread risk across their asset classes, sectors, and geographical regions. So it can be having mutual fund investments that focus on domestic and international equity funds so that you can benefit from growth opportunities worldwide. You can have your fixed income funds to generate regular income and reduce your risk. Your money market funds will also serve that same purpose. And then you can have your alternative investment funds that focus on real estate, on commodities, to just, mix up the portfolio even further to put you into a different type of market that those other ones tend to not put you into. So that's a pretty good way to combine different types of mutual funds to spread your risk across different types of investments.
Okay, so you've spoken around diversification and spreading risk. Can you just provide an example of what this may actually look like?
Certainly. So, for example, an investor can have, let's say, 40% of their mutual fund investment in domestic equity funds. So they will focus on stocks that are listed on the NGX. Then 30% to international equity funds. Maybe they focus on the NSE in America or the London Stock Exchange, anywhere that does well, or in developing markets like Brazil, Russia, India, China, South Africa, wherever there are growth opportunities to be found. Another 20% to fixed income funds. So those are focusing on your government bonds, your corporate bonds that are issued by banks or like corporate entities of high financial standing. And then you could have 10% that goes to alternative investment funds. So like your real estate trusts or something that focuses on commodities, which are, obviously well traded as well. And yeah, so that's like a pretty strong breakdown. You have 40 to equity, 40 to domestic equity, 30 to international equity, 20 to fixed income, and 10 to alternative, which brings you to a nice round number of 100%.
That's a very well-rounded portfolio, pretty much diversified. So tell us, what's the benefit actually of using this approach?
So when you spread your investments across asset classes and sectors, you can reduce your exposure to any one particular market. So let's say your domestic stocks are not doing very well. For one reason or another, the economy in Nigeria isn't great, right? And, your stocks are losing some value. By diversifying your portfolio, you can rest assured that you still have a good amount of your investments in international equity, and you have another good amount in fixed income bonds. Usually when the equity market isn't performing so well, it means that the fixed income market is going to perform well. Those two things tend to have an inversely related relationship. So you are going to be buoyed by that counter. And then you have your real estate and alternative investments. So rather than experiencing 100% exposure to your domestic equities, you've diversified your portfolio and ensured that while one portion of your portfolio isn't doing so well, the others are helping counterbalance the effects of that. So in the end, you come out just okay. Sometimes you may even come out better than okay.
That is truly amazing. So now, what are some important factors to consider when building a portfolio with mutual funds?
Okay, so as an investor, it's good to know yourself to a certain extent. And in knowing yourself, these are the things that I mean. You need to know what level of risk you can tolerate. So what's your risk tolerance? And it varies from individual to individual, but generally there are some broad strokes that apply to, certain demographic groups generally, right? Younger people tend to have a greater risk appetite, and older people tend to be more risk averse, So youngers may focus on opportunities that will help them grow quickly, while people who are older, they have dependents, they're focusing on their retirement and whatnot. They are more focused on their capital preservation. So each individual needs to know what level of risk that they are able to tolerate. Then you need to know what your investment horizon is. When you're putting money down as an investment, you need to consider, when am I going to need this money? Right? And that should play a role in determining what kind of mutual fund you're going to purchase, right? Then what are your financial goals? Are you looking to grow your money very quickly, or looking for the opportunity to experience that kind of growth? Or are you happy with the amount you have and you are just looking to, beat inflation and just stay above water because, you're not overly experimental? These types of things, they play a big part. What is the performance of the fund that you're investing in? So the historical performance, how long has this portfolio manager been running this fund? Historically, have they outperformed their competitors, or have they outperformed the benchmark for that type of fund? Also, what are the fees that the portfolio manager is going to charge for the privilege of managing your money? What are the management fees? What are the incentive fees? Are there other hidden fees that you don't know about, but you should know about so that you don't get extorted? These are important things. And lastly, the manager expertise. How well do they know the market that they are investing in on your behalf, right? What's their track record? At Coronation Asset Management, we have a very strong track record of performing well in the fixed income and equity spaces, as well as doing other sort of alternative investments, creative investments that help our portfolio clients as well as subscribers to our funds to achieve their goals and also to hit their investment targets.
Those are all crucial factors. Just to summarize for our listeners, we've spoken around 1, your risk tolerance; 2, your investment horizon; 3, financial goals; 4, the fund performance; 5, fees; and 6, the manager's expertise. Now let's just drill down on what you spoke around fees. Can you elaborate on the importance of these fees?
Yes. So because of their professional expertise, portfolio managers have to charge to help you grow your money, right? But if fees are exorbitant, then they can eat into your returns over time. So you want to look for funds whose fees are relatively low. You want to, when you're looking at their financials, because funds also publish their financials, you want to see funds that have low expense ratios. And when you find funds that do that, they can help you keep more of your returns because these fees are being paid out of whatever is being made on top of your investment. So fees are a very important thing to look out for.
That's a really good point. So please, listeners out there, look out for the fees. Ensure that you understand clearly what the fees on your funds are. Okay, so how about tax implications? Are there any tax implications when it comes to mutual funds?
So tax efficiency is important as well. Consider the tax impact of your investments and aim to minimize tax liabilities. So for example, tax loss harvesting can help offset gains from other investments, right? There are certain investments that are going to be tax-free, so your tax exposure in certain types of funds is going to be lesser than in others. Money market funds primarily focus on treasury bills, so a majority of what makes up the portfolio is tax-free. Only a smaller portion is actually taxed, so you'll get to keep a lot more of your returns,
I think even I myself just learned something there. So good advice. So do you have any final advice for our investors who plan to build a portfolio with mutual funds?
Yes, I would say that to investors, it's always best for you to stay disciplined, stay patient, and stay informed. You may not be able to know everything, but a little information is better than no information, right? Read as
Very
much
true.
as you can about anything that has to do with the financial markets or the economy, and get your level of information up, and that will help you to understand what you're doing. Try to avoid making emotional decisions based on short-term market fluctuations. You want to be calm and considered when you make investment decisions so you don't do things that you regret. And you want to regularly review and rebalance your portfolio to ensure it remains aligned with your goals and risk tolerance. Say every quarterly period or maybe half year, you just want to look at what your investments are doing overall, like a bird's eye view, and then take considered decisions, either on your own or with the advice of your portfolio manager who would be able to help you sift through your thoughts and help you stay focused on whatever your financial goals and objectives are.
Great advice, Okene. So that's all we've had the time for today. I know we've spoken a lot around portfolio construction, mutual funds, diversifying your portfolio using mutual funds. So before we end this edition of the Coronation Podcast, we will recap some of the tips. Okay? So Somkene, can you just give us what are your final tips for our listeners? You've shared your expertise on portfolio construction using mutual funds. If you could summarize or recap, what would you leave our listeners with?
Okay, so if I were to summarize, I would want people to take away 3 salient points, right? Number 1, start with a clear financial plan so you understand your goals, your risk tolerance, and investment horizon before you build your portfolio. That's very important. Number 2, which is what we began with, is to diversify your portfolio. Spread your investments across different asset classes, different sectors, if possible, different geographic regions so that you can minimize your risk as best as possible. And finally, you want to regularly review and rebalance your investments so that you can stay on track with your financial plan. You want to adjust your portfolio as you need to so that it remains aligned with whatever your goals and objectives are, as well as your risk tolerance. Your risk tolerance today may not be what your risk tolerance is in 2 years' time. So you always want to reconsider whatever is pertinent to your own situation immediately.
Awesome. I believe that was excellent advice. And to our listeners out there, by following these tips, you can create a well-diversified portfolio that helps you achieve your long-term financial objectives.
Absolutely. So remember, portfolio construction is an ongoing process. Stay informed, stay disciplined, and stay patient.
Thank you again, Somkene, for your insights and expertise. So, if our listeners want to learn more, where can they go?
So they can visit us at our website. It's www.coronation.ng, or they can consult with one of our financial advisors from Coronation Asset Management for personalized guidance. Our offices are at number 10 Amodu Ojikutu Street in VI, but we can also be reached online and on the phone. So yeah, we are here for your personalized guidance.
Great resources. So thank you to all our listeners for tuning in. And until next time, stay informed and invest wisely. Bye-bye.
This has been the Coronation Podcast. Thank you for listening.